car insurance bill didn't just go up, it exploded. The average full coverage premium jumped from about $1,200 a year in 2019 to over $2,500 by 2024. That's about $212 a month now, more than double what drivers were paying in 2019 before you even turned the key. And here's the part that should bother you. You didn't drive worse. You didn't file a claim. Nothing about you changed. In early 2024, insurance inflation hit 20.6% year over year, the highest reading in the entire history of the government's index, and roughly 10 times the pre-pandemic normal of about 2%. So where did all that money actually go, and who is it really paying for? Because by the end of this video, you'll see you're covering a long list of costs that have nothing to do with your driving. Two real causes did this. A third nobody wants to talk about is keeping it high. And at the end, the three moves that actually cut your bill. And this isn't one cherry-picked number. Two official measures tell the same story from different angles. The NAIC, which tracks average expenditure across every policy type, shows the conservative version. $1,075 in 2019, climbing to $1,281 by 2023. Bankrate's full coverage benchmark shows the sharper one, $1,194 up to $2,543, more than double in 5 years. Whichever measure you trust, the direction is identical and undeniable. Up fast and far beyond anything normal inflation explains. The pain is not evenly distributed. Michigan drivers pay $386 a month, the highest in the nation, because of state-mandated unlimited medical coverage. Florida averages $249 a month, close to $3,000 a year. Louisiana drivers spend between 5 and 6.5% of their median income on auto insurance alone. In 2023, auto insurance inflation ran at 2.7 times the overall national CPI rate. It was not a blip, it was a structural repricing. So let's follow the logic, starting with the machine that quietly rewrote what your car costs to fix. Cause number 1, the car itself. In December 2021, the Manheim Used Vehicle Value Index, the gold standard benchmark for wholesale used car prices, hit an all-time record of 257.7. That was a 46.6% year-over-year increase. The cause? COVID-19 disrupted semiconductor fabs in Asia, and modern vehicles need 1,000 to 3,000 chips each. Global auto production fell 26% in the first 9 months of 2021. Fewer new cars meant used car prices went vertical. When a car's market value doubles, the insurance math changes entirely. Insurers declare a total loss when repair costs approach the vehicle's actual cash value. With used car prices up 40 to 50%, vehicles that previously would have been repaired were suddenly worth totaling. The total loss rate on collision claims jumped from roughly 20% pre-pandemic to 27% by 2022. That meant insurers were writing much larger checks, often $8,000 to $15,000 more, on ordinary claims. Even repairable claims got dramatically more expensive. Before the pandemic, auto repair inflation ran 3 to 5% per year. By 2022, it was over 10%. The average repair estimate hit $4,721 in 2023, and a big reason is the electronics packed into modern vehicles. A AAA study found that ADAS, Advanced Driver Assistance Systems, adds up to 37.6% to the total repair cost. A windshield replacement that cost $300 before ADAS can now run $1,500 because the forward camera requires mandatory recalibration. There is also a technician shortage that is not getting better. The TechForce Foundation projects a national deficit of 795,000 trained automotive technicians by 2027. NADA estimates 56,000 positions are unfilled at franchise dealerships right now. When there are not enough techs, wait times for repair appointments rose from 1.8 days in 2021 to 4.8 days in 2023, a 167% increase. Longer repairs mean longer rental car claims. All of that flows directly into the premium you pay. Cause number 2, the weather and the global machine that prices it. Swiss Re tracks global insured catastrophe losses. From 1980 to 2016, losses only crossed $100 billion in exceptional years. Then something shifted. 2020, $83 billion. 2021, $112 billion. 2022, $2023, $2024, over $100 billion every single year. 2024 hit $141 billion. That is now the baseline, not the exception. And much of that is happening in the United States, which has seen billion-dollar weather events go from averaging 9 per year in the 1980s to 23 per year from 2020 to 2024. Hurricane Ian made landfall in southwest Florida in September 2022 as a Category 4 storm. Total economic damage, $109.5 billion, the costliest hurricane in Florida history. There were 123,299 private passenger auto claims filed. CARFAX estimated 358,000 vehicles damaged across Florida and the Carolinas. During Ian's peak days, 52% of vehicle claims were declared total losses, versus a normal baseline of 16 to 18%. A single storm tripled the total loss rate across an entire state. When primary insurers absorb losses of that scale, they turn to reinsurers, the backstop companies like Swiss Re and Munich Re. After 2022's catastrophe year, reinsurers repriced aggressively. At the January 2023 contract renewals, global property catastrophe reinsurance rates rose an average of 37%, the largest single-year jump since 1992. U.S. rates hit 17-year highs. That cost did not stay with the reinsurers. It cascaded down to State Farm, Allstate, Progressive, and ultimately to you at renewal time. Here is the part the industry does not advertise. The industry-wide combined ratio, claims plus expenses divided by premiums, hit 112.2 in 2022. That means for every dollar collected, insurers paid out $1.12. State Farm reported a record $13.2 billion underwriting loss across its property casualty group that year. GEICO fell from a $3.4 billion profit in 2020 to a $1.88 billion loss in 2022. The companies were genuinely losing money underwriting auto insurance. Now, before you type, insurers are just greedy into the comments, you're half right. And here is the half that's true. Insurers hold massive investment portfolios. Your premium payments earn investment income before any claim is paid. Berkshire Hathaway, GEICO's parent, invests that float in equities and bonds. So even in years where combined ratios exceeded 100%, most major insurers did not post net enterprise losses. The underwriting crisis was real, but the "we're losing money" narrative requires that asterisk. By 2024, the industry had turned the corner. Allstate's personal auto combined ratio fell back below 97. GEICO's profit hit $7.8 billion. Profitability returned, but rates lag. State rate filings require regulatory approval that typically takes 6 to 18 months, and actuaries price for future losses, not last year's profits. Now the third piece, the one nobody wants to talk about. Your premium also pays for something you did not do: litigation. In Louisiana, 49% of accidents result in a bodily injury claim versus 26% nationally. Louisiana has 1.4% of the U.S. population, but files 3.65% of all U.S. bodily injury claims. Drivers there pay an extra $1,180 a year, a tort tax, per the Perriman Group. Social inflation, nuclear verdicts, litigation funding from hedge funds, aggressive legal representation drove bodily injury severity up an estimated 7 to 10% in 2023, according to industry data from CCC Intelligent Solutions and LexisNexis. That gets priced into your policy whether you ever set foot in a courtroom or not. And your zip code matters more than your driving record in many markets. The Consumer Federation of America profiled identical good drivers at addresses 100 yards apart in Buffalo, New York. The driver in the lower income zip paid 34% more in premiums than the one next door, same coverage, same profile, same car. Insurers pool risk by territory. If your neighbors file more claims, have more uninsured drivers, or live in a place with higher theft rates, you pay for that. It is not personal. That is exactly the problem. So here are the 3 moves. Move 1, the single most effective. Shop every 12 to 24 months. J.D. Power found that 57% of customers shopped in the past year, the highest rate in the study's 19-year history. Of those who switched, 92% saved money. The median savings from switching was $461 per year according to LendingTree. Insurers use price optimization algorithms. They model the highest premium you will tolerate before leaving. Long-tenured customers quietly pay more. The loyalty penalty is real, and it is legal in most states. Move 2, your credit score, the most powerful non-driving factor most people ignore. In 46 states, insurers use a credit-derived insurance score to set premiums. Drivers with poor credit pay 109% more on average than those with exceptional credit for the exact same driving record, according to the Zebra's 2025 research. If your credit has improved since you last shopped insurance, requoting could produce significant savings immediately. 4 states ban this practice entirely: California, Hawaii, Massachusetts, and Michigan. Move 3, your deductible math. Raising your deductible from $500 to $1,000 saves an average of $188 per year on premium. The break-even point is about 2.7 years without a claim. If you have the savings to absorb the higher out-of-pocket, and J.D. Power found 26% of customers are now carrying $1,000 plus deductibles. This is a straightforward trade. If you cannot write a $1,000 check after an accident without financial stress, do not raise it. The point is to make an active decision, not accept whatever renews automatically. And that question we opened with, where did all that money actually go? Now you know. Total losses, ADAS recalibrations, catastrophe reinsurance, litigation, your neighbor's zip code. Almost none of it is about how you drive. You can't fix the industry, but you can stop being the easiest person in it to overcharge. This video is for educational and informational purposes only. Nothing here is financial advice. Always do your own research before making any investment or financial decision. All claims in this video are backed by verified, publicly available data. Sources are shown on screen.